I want to bring in all our team coverage. We've got Scarlet, who's watching the markets. Dominic is down at the CME with a trader. We're going to get his reaction in just a moment. But I've also got Chris Lowe here. He's the economist at FTN Financial. But Chris, just hang on. Let me get to Scarlet. I want to know what the market reaction is. Scarlet?
Betty, we're taking a look at equity index futures under pressure, but they have given up a little bit of their decline following that somewhat better than expected read in jobless claims. 400,000 as opposed to the more than 400,000 expected by economists. So the S&P futures were down by about 1.1%, now down only 0.9% only. But what you can see here is that over the last few hours, we have really taken another leg down, and we hit our session lows right before the jobless claims numbers came out. Let's show you what's going on in treasuries. There continues to be buying in treasuries, although it's let up a little bit following the jobless claims number. 2.58% is the yield. It was at about 2.569% before the number came out. So while there is still demand for treasuries, it's eased up just a little bit following the 8:30 number. And just to put that into perspective for you once again, the jobless claims number at 400,000 even, as you mentioned, what we've seen is jobless claims has held above this 400,000 line for quite a while. Last week we got a reprieve. It was the first drop below 400,000 in about 16 weeks, but we're back above that number again. So it's a very significant number psychologically. And just very quickly here, let's show you what's happening with gold prices. They continue to be firmer among all the commodities, up 0.3%. Betty?
Okay, Scarlett, thank you. And just hang on, Chris, I do want to pick up from what Scarlett said. I mean, this 400,000 level has been very important to watch here for the markets.
Yeah, you know, traditionally 400,000 is a line that we draw that separates recession from expansion. I don't think that means we're going into a recession just because we're sitting at 400,000, because, of course, we haven't been able to get down through that level since '07. We've you know, had that terrible recession, got up well above that level, and we've been gradually coming down. Looking at this week, though, individually, the 4-week average continues to come slowly downward. We've been coming down for a month.
It's been actually the one positive in all of this economic data.
No, I was really excited when you invited me to come on today, because I thought, okay, maybe I'll have a chance to talk about a good number. Everything else this week's been lousy.
It has.
But it also has been the best leading indicator, both of where the economy's going and where the markets are going.
But is it really?
For the last
because
3 years.
Absolutely.
Yeah,
but Chris, everything else has been pointing. I mean, as Al Broadus was just saying, I mean, like, we've had all these revisions lower in these last few quarters. So has it really been a reliable indicator, though?
Remember when everybody was so optimistic? The market was roaring back in April, right? And we continued to get good numbers on the employment report as well. But at that time, in April, jobless claims rose, reversed the entire drop in the first quarter. It was the first indication something was wrong. And now, of course, everyone knows something is wrong.
Yeah.
I think this is the first indication maybe something is right.
Okay, Chris, hang on. Let me get to Dominic. As I mentioned, he's down at the CME right now for a change with a trader. Dom?
Yeah, Betty, what we're talking about right now is wildly an interesting couple seconds here, but with those jobless claims coming in as expected here, in line. But again, that 400,000 level, like Scarlett was saying, very much key here. We're watching those futures actually start to get back a little of that ground that they lost here in a rather volatile session. Well, I want to get to what Kevin Craney is saying. Kevin Craney is a trading advisor at RJO Futures. And Kevin, I want to get your reaction to this. Was this anything that you were expecting? Was this something that just was out of left field, or was this something that you could hang your hat on, so to speak, for the markets?
I think it's something that the market's kind of hanging their hat on. Prior week revised to 401. We're down 1,000 this week. We hang around that 400,000 level. The big number's coming tomorrow. Everybody's looking for it. Market's expecting 85,000. I'm looking for a 60,000 print on the unemployment claims tomorrow. I think it's a little worse than expected.
60,000.
I think it's a little worse than expected.
Now, do you think that there's a setup one way or the other? Do you think most traders are thinking that it's going to be worse than expected, or do you think that the risk could be that we have a better number than people think?
I think right now the market's priced in that worse than expected number. So if you get a number that's a little better, then I think the market could actually pop on that, particularly after the sell-off we've seen for the past couple of days. But I think risk aversion is clearly in the market right now.
Really quickly, one more thing here. Is this something that is jobs all it's all about?
Right now, at this point, jobs is all it's about. That's what we need. That's what's going to turn the economy around, and that's what's going to get things going again.
Perfect. You heard it here, Betty. Back to you.
Dom, thank you. And, as Chris, as Dom was just talking about with Kevin there, I mean, jobs obviously is what it's all about for the market. Yep. So this jobless claims number tells you what about tomorrow's data?
Well, unfortunately, this jobless claims number tells you more about August than about July. And tomorrow's number is July. So I think, well, in fact, my estimate's the same. We're looking for 60,000 as well. It's not as bad as the last 2 months, but it's still pretty bad. So claims have been about a month out in front of all the other data for a couple of years. I think that continues to be true today. A month ago, claims were going sideways.
Yeah.
And so we get job numbers tomorrow that are probably going sideways as well. So maybe another month of frustration. But I think we're pretty close to turning towards something a little bit more optimistic. And I do want to stress
in the jobs market.
A little in the jobs market, in the economy in general. But better than what we've seen this month.
Okay, all right. Well, that's a little different from what we've seen. Yes, Scarlet.
I just wanted to jump in for a moment here because we saw European Central Bank and the Bank of England this morning leave interest rates unchanged. The Fed will be meeting next week, and Ben Bernanke will be under pressure to say something about the revisions on the GDP, the threat of another recession. What could he say at this point that will calm the markets aside from another round of stimulus?
Well, I think we'll get a tease that maybe there'll be another round of stimulus, and possibly what they'll do is commit to keep rates low for even longer than an extended period, whatever that is. But beyond that, Fed really doesn't have a whole lot they can do. I think if there's any glimmer of hope they can find in any of the data, they'll highlight it. But at the same time, maybe just sort of a hint that they'll do something down the road.
Well, just to quote Al Broadus again, I mean, he was saying that, look, I mean, they've got to get those inflation expectations down before they pull any trigger on anything.
Absolutely. And I think what Al said was spot on. Yes, the one maybe positive of QE2 was to rein in deflation expectations. Right. But to do it, they crushed consumption because they caused a really significant surge in inflation.
Chris, these headlines just came across during the commercial break about ECB's Jean-Claude Trichet, talking right now. He's saying that, quote, downside risks to growth may have intensified. As you can see, he's speaking right now in a press conference. It also says that risks to the inflation outlook remain on the upside. So what do you make of those two comments? What's he trying to broadcast?
Well, look, I think he's slowly backing away from the hawkish language of the last meeting. They raised rates at the last meeting. And surprisingly, he signaled that there would likely be another rate hike in October. Yeah. So what we're doing here is they're leaving that inflation risk on the table, but they're adding the economic risk. And by doing that, it's a more balanced. I think, in fact, what he's signaling is they're on hold.
They're on hold on rates then. So we may not see one in October, essentially.
Yeah, look, Trichet has, if anything, contributed to the peripheral debt crisis because by raising rates, he's increasing the economic pain in Italy, in Spain, in Greece, in Ireland. He's doing it because there's an inflation problem in Germany.
Right.
But I would argue that better to have inflation in Germany than deflation in the periphery right now.
Well, what's interesting, Chris, and we were talking about this, is that, I've been on the floor of the exchange around mid-morning. That is when the European markets are about to close. And every time I've been there in these last few days, traders have been coming up to me and saying, look, we're following European shares lower right now. That's why we're seeing this leg down, or this is why suddenly there's a sell-off going on. What is going on? It feels like we are on the cusp of something happening in Europe. There's nervousness here in the U.S. It's not just about Washington, not just about recession here. It really is also about Europe, and I don't think that's something that's been broadcast as well.
I think the crisis there has transformed in the last couple of weeks. It is still this peripheral sovereign debt crisis, the pigs, but beyond that, it is now a pan-European banking crisis in the making. And that's because, one, their shares are under pressure. Two, they're losing access to short-term funding. And you can see that in LIBOR rates, which have spiked higher in recent days.
Right.
A lot of that short-term funding was coming from money market funds here in the U.S. They are no longer willing to lend money to those banks. So this means now that it's not just in the periphery, but it's UK banks, it's German banks, French banks, Swiss banks. If they lose access to funding, remember, they're only capitalized at about a third of the level of U.S. banks. So they are much more vulnerable when they lose funding than we are.
Chris, thank you so much. Really appreciate you joining us to talk about all these topics. Chris Lowe of FTN Financial.